Over the last few years, we've seen some fantastic interest rates for savings. Although they are declining right now, they're still pretty competitive. And if you have a decent amount of money saved away at these rates, that could mean you are liable for tax on some of that interest that you have earned. The good news is there are a number of allowances and different types of accounts that can help you avoid most, if not all, of that. And I'll take you through each of those so you can decide which route you want to go down. First of all, though, I do want to be really clear on something. This is just about tax on interest earned on your savings, not tax on your savings. It's something that people often get confused about, and understandably so when you hear people talking about this. But the money that you've earned, whether it's from your income or from anywhere else, right, that has probably already been taxed, or it was already tax-free, right? It's just the income you earn on that. So the interest on that could be subject to tax. So don't worry, there's no double dipping. If you put £1,000 in savings, they're not going to take away any of that. It's just if you earn money on top of that, that could well have some of that taken away. Okay, let's start at the beginning then with the first allowance that could impact our savings. And this is the personal allowance, or the personal tax allowance. And this is something that pretty much all of us will get. It does disappear, obviously, if you're an additional rate taxpayer. But for most of us, the first chunk of any income that we receive is tax-free up to that total of £12,570. Now, for most of us, that is used against our income, against our salary, right? So we get paid, I don't know, 30 grand a year, then you don't pay tax on that first £12,570. You only pay tax on the amount above that. But if you don't have a job, maybe you're retired, or maybe you're a low earner, so you earn less than £12,571, then you will be able to still get the full allowance, and you can use that for your savings. So maybe if you have nothing at all coming in, all your income as a retiree is from savings, then that £12,570 of interest that you earn is tax-free, that first amount. So this is a good thing for some of you to remember. Obviously, it won't impact most of us. But if you are also someone who earns less than £17,570, there is an additional starting rate for savings that you can apply to this as well. Now, how much of that extra £5,000 you get depends on how much you earn. If you earn £12,570, then you've got another £5,000 in full that is purely for savings interest. Okay. If you earn 17 grand from, let's say, from your job, well, then you'd still be entitled to this starting rate for savings, but you'd only get an extra £570 of that tax-free allowance. Again, this is on the interest that you would earn from those savings. But it could be, that means as a retiree or someone who earns no money at all from income, that £17,570 of interest from your savings completely tax-free every year. Of course, again, most of us, that's not going to apply to us, or it's not going to apply to us just yet. But there is an allowance that at the moment, most of us will get as well. And this is called the Personal Savings Allowance, or the PSA. Now, how much of this PSA you get does depend on your tax bracket. So we talked before about the tax-free allowance up to £12,570. If you earn above that, up to £50,270 a year, you're known as a basic rate taxpayer, and you get a PSA of £1,000. So you can earn £1,000 in interest that is completely tax-free. If you are a higher rate taxpayer, so you earn between £50,271 and £125,140 a year, then you get a lower £500 personal savings allowance. If you're an additional rate taxpayer, so you earn more than £125,000, £141 a year, then there is no PSA at all. Obviously, if you live in Scotland, these rates are slightly different, but this is for everyone else. So this can be, for most people, a reason why you never pay tax on your savings at all. Because to earn £1,000 in interest every single year can require a hefty amount of money. Yeah, we have had some really decent rates of interest over the last few years. You could get fixes of around 6% at one point. It's still, at the time of recording this, possible to get 7% in some regular savers. So it is possible that you could be getting really, really high rates out there. And obviously, it's possible that you have decent chunks of money put aside. We know most people in the UK don't have huge amounts, but obviously some of you will have that. So to give you an example, let's look at a rate that has been relatively easy to achieve over the most of 2025, and that is 5%. Yes, it's harder to get that right now, but again, we talk about this during tax years, April to April, so you might already be being impacted by this for most of the year. But let's say you're getting 5%. As a basic rate taxpayer, you would need more than £20,000 saved for you to get interest that goes over that £1,000 savings, personal savings allowance. If you're a high rate taxpayer, then it drops down to £10,000 saved in order to generate £500 of income from interest. 5%, okay, might not be so realistic now, but let's look at 4%. That would be 25 grand that you'd need saved up to go over £1,000 in interest as a basic rate taxpayer, and £12,500 as a high rate taxpayer to earn more than £500 in interest. Now, if we continue, which is expected now to see interest, or the base rate of interest at least, fall down, and as a result banks reduce the top rate of interest they earn. Again, this is only about people who are moving their money around, hunting around for the best savings rates, who are getting these high rates. If you've just been sitting with any old bank, you're probably getting a lower rate anyway, although it's not, this potential tax is not a reason to go for lower rates, I should say. But let's say it drops down to 3% as a kind of one of the best options you can get on your savings. Then a basic rate taxpayer would need 33 grand saved to generate a grand in interest, whereas a high rate taxpayer would be nearly £17,000 saved up to generate £500 of interest. So you can see from that, for a lot of people, there isn't going to be an issue at all. The personal savings allowance will completely cover you. In fact, when we were looking at top rates of 1% just, 7-8 years ago, then you need 100 grand saved up. But again, hopefully we won't go back to anything that low on interest rates. And again, just want to reiterate what I said just there. You don't want to be getting a lower rate of interest to reduce the possibility of you paying tax. You're better to earn more interest and pay tax on some of that if you need to. And if you want to find the best possible rates at any time, remember, over at becleverwithyourcash.com/savings, myself and the team are updating every single day the best easy access, the best regular savers, the best fixed rate savers, the best notice accounts, the best ISAs, which we'll come back to in a moment, to help you get the best possible rates. Now, it's also worth just being clear here about what happens if you do go over your personal savings allowance, because let's say you are a basic rate taxpayer with that £1,000 personal savings allowance and you earn £1,050, that £1,000, that first £1,000 of interest is still tax-free. It's just that 50 quid that went above it that would be taxed, and it'd be taxed at your marginal rate, which is a basic rate taxpayer is 20%. Okay, so you'd lose £10 of that 50 quid. If you earn the same amount of interest, £1,050 as a higher rate taxpayer, then obviously there's more that's going to be due for tax there. 550 quid is the amount over your £500 PSA, and that would be subject at your marginal rate at 40%. So you can see obviously that if you are a higher rate taxpayer, it does become more pressing for you, more risky for you, that the more you earn, the more tax you're going to be paying. And of course, you might be thinking, well, at the moment, it's fine. I'm a basic rate taxpayer and I'm not going to be worrying about that. And that £1,000 PSA is fine for me. But don't forget, the tax brackets have been frozen for a while now, and they're likely to be frozen for a good few more years yet. And that means any pay rise you get might sound like great news, but obviously it could well push you over that bracket, over that 50,270 from basic into higher rate, or even that 125 grand annual salary bracket between higher and additional. So just bear in mind that and plan ahead a little bit. If you think that could be happening or due to happen, then you'll want to think about ways that you can avoid that. I won't go into a huge amount of detail on this now, but potentially if you have a lot of money, then you can reduce your effective tax band by putting more into your pension. And that could obviously reduce you from an additional rate into a higher rate taxpayer, or from a higher rate taxpayer into a basic rate taxpayer. And then for not just increasing your PSA, but reducing the tax that you would be due on the remaining amount of interest. But let's talk then about, let's say you are going over the PSA and you're going over all these allowances so far. That is not the end of the road, because there are some other accounts you can get, and you know these accounts, where everything you earn from them is tax-free. So for ISAs, it's either cash interest from a cash ISA, or, I know we're talking effectively here on savings, but don't forget there are stocks and shares ISAs, and there are innovative finance ISAs, and there are lifetime ISAs. Or from premium bonds, where the prizes you get, which is a cash prize, they are tax-free as well. Let's focus on ISAs first of all. Now, at the moment, or recently, there's been a huge amount of competition, particularly on easy access ISAs, where they've actually been paying, in many cases, higher rates than you would get from a non-ISA account where tax is due. So it becomes a bit of a no-brainer. If you've got some easy access money to put aside, you put it in an ISA, you're getting a higher rate, and you are getting returns which are completely tax-free, which don't even add up don't even work towards that PSA. So it's a win-win there. It's a great way of doing it. One thing you do need to think about here, though, is even though the income that you get in ISAs is tax-free, is a different case if the rates are significantly lower than what you get from an account outside of an ISA. You might actually want to be putting the money outside the ISA in order to and pay tax on it, because you still could get more money overall. Again, it's been a bit different recently because you've had that battle with the easy access ISAs to bring them up the rates there. But on fixes, again, you might decide, do you know what? I'll get a much better rate over there. And even if it takes me over my PSA or my other allowances, I'll be paid tax on it, I'll still be better off. Of course, that isn't the only tax-free account that I mentioned at all. We did talk about premium bonds as well. Now, premium bonds, anything you win from them is set at to be tax-free. It comes through to you, so which can be great, and you can win as much as £1 million. But you probably won't. You're more likely to get a lot less than that. And equally, if you don't have balances approaching the maximum £50,000, which you can put in premium bonds, you might find that your chances of winning anything at all are really much greatly reduced down to almost nothing at all. You are not guaranteed to win anything with premium bonds. So although I think they can be great for those additional rate taxpayers where 45% tax is due on any interest that you earn, so putting another 50k in premium bonds on top of anything you've got in your ISA, if you have that amount of money put aside, is probably worth a look. For those of you who have still got your PSA, who have got your ISA allowance, potentially you've also got your tax allowance and your starting rate for savings, premium bonds probably aren't going to win through. And the other thing you need to remember as well about premium bonds is, yes, you can put up to 50k in there. And again, if you're going to use them, the closer to 50k you have, the better chance you've got of getting closer to their prize rate. That is a lot of money to have put aside in savings. Most people do not need to have so much available to them. Of course, if you're retired and you've de-risked a lot of your investments, that's another matter. But for most of us now, once we've got any emergency fund covered, any other immediate expenses coming up covered, we probably don't need to be having more than that in savings. And we should be looking instead at putting more into our pensions, putting something into the stock market, maybe overpaying our mortgages, rather than having it sitting in cash, because ultimately the return is going to be lower. But again, I've covered premium bonds in more detail elsewhere, so you can check out that content to understand how they work a bit more. So there you go. These are the ways that you can legally avoid, if not reduce, the tax that could be due on your savings interest. My name's Andy Webb. Check out these videos here for more ways to make the most of your money.